everything you know about where money comes from is wrong. If you're like most people, you probably think that money is created by the government, but that's only partially true. In modern developed economies like the US and the UK, less than 10% of what we call money is created by the government, specifically central banks. The rest is created by private banks. Yes, those same banks that you keep your money with, like Chase, Bank of America, or Barclays, create most of our money. They do this every time they make a loan. For instance, say you want to buy a house, so you take out a mortgage with your local bank. The money that the bank gives you is created out of thin air. This is a key point that a lot of people don't understand. Even introductory economic textbooks get this wrong. They claim that banks lend out the money that people put into their checking and savings accounts. Based on that, banks can only lend out the money that already exists and is deposited with them. But that's not correct. Banks can lend out as much money as they want, and all of those loans are made up of money that the banks create. Now you might be thinking, if this is true, what's to stop a bank from creating an unlimited amount of money to enrich itself and its executives? So let's talk about why that doesn't happen. The first thing to understand is that there's a few different kinds of money. To us, money is money, but it turns out that not all money is the same. One type of money is the type I've been talking about, deposit money. This is the type of money you see in your bank account. It's completely digital and only exists as numbers in a database maintained by your bank. But there's other types of money as well, like physical currency, which everyone is obviously familiar with, and something called reserves, which is money held by private banks at a country's central bank. So this is money held at the Federal Reserve by Wells Fargo or at the Bank of England by Barclays. This is another type of digital money that lives in the central bank's database. Together, physical currency and these reserves are called central bank money because they're created by the central bank. So how does this all tie together? Well, as I said before, banks create deposit money through lending. But after a bank makes a loan, that money doesn't necessarily stay with that same bank. If you take out a mortgage with your local bank, the bank pays you money, and then you pay that money to the seller of the house that you purchased. The money then ends up in the seller's bank, and there's a good chance that the seller's bank is different than your bank. And as a result, your bank has to send money to the seller's bank. How do banks send money to each other? They transfer the reserves that they keep at the central bank. The central bank acts like a banker for the private banks, allowing them to send money back and forth to each other. Banks can only create deposit money. They can't create central bank money, which is what they need to send money to other banks. So the fact that money flows in and out of individual banks is a constraint on the amount of money that banks are willing to lend, because they need a certain amount of central bank money on hand to send to other banks in case they have to. This might make more sense if we look at it visually. These are the balance sheets of two banks involved in the purchase of a house. Both the home buyer's bank and the home seller's bank start with a combination of currency and reserves, which together are central bank money. Those are the bank's assets. And on the other side of the ledger are the deposits that customers hold in their accounts. To us, that's money. It's an asset. But to the banks, it's a liability. They owe us that money. Now let's look at step 2. Your bank gives you a mortgage, so it credits your account by the amount of the loan. Your checking account balance goes up, which again to the bank is like an increase in liabilities, while the mortgage itself is an asset to the bank, which it expects to be repaid with interest. So you can see when you take out a mortgage, money is created out of thin air. This new money in your account didn't exist before you got that mortgage. Now in step 3, you take the money that your bank lent you and you send it to the home seller. If the home seller uses the same bank as you, then the bank could simply transfer some of the deposits in your account to the home seller's account, and it wouldn't have to do anything else. It would just be moving numbers around internally within its own database. But more likely, the home seller uses a different bank, so your bank will have to make a bank-to-bank transfer using central bank money. That reduces your bank's reserves and increases the reserves at the home seller's bank. Additionally, the home seller's bank credits their account with new deposits. Now, if you compare this first chart to this last chart, you can see that the total amount of money did increase by the amount of the mortgage loan. But your bank's reserves went down a lot, which reduces the amount of money it can lend in the future. On the other hand, reserves at the home seller's bank went up, which increases the amount of money it can lend. So as you can see, banks need reserves on hand in case customers take money out of the bank. And that limits the amount of loans that any individual bank can make, and thus how much money they can create. The good news is that reserves are almost always available to banks at the right price. There's a few ways that they can get them. They can try to get customers to add more money into their accounts. Just like we saw in the example with the mortgage, mortgage, when the home seller got paid for their house, that inflow of money resulted in the home seller's bank getting more reserves. Another way a bank could get reserves is by borrowing them, either from other banks or the central bank itself. When it does this, it has to pay an interest rate to whoever it's borrowing the reserves from. And in fact, this interest rate is the way in which central banks conduct monetary policy. By setting the interest rate that banks pay to borrow reserves, the central bank can influence how much lending and money creation happens in the economy. When banks can borrow reserves at a low interest rate, they're more likely to be able to lend out money profitably. There will also be more demand for loans from businesses. Of course, the opposite is true as well. When interest rates on reserves are high, you're going to see less lending and money creation. So there you have it. Banks create money, but the amount of money that any individual bank can create is limited by its access to funds called reserves. These reserves are readily available at a price set by central banks. And finally, here's a cool corollary to the fact that banks create money by lending. When you repay a loan, and that includes when you repay your credit card balance, you're destroying money. That money no longer exists in the economy. Hope that helps, and subscribe for more insights on business, investing, and the economy.